Countdown. Where's the countdown?
He doesn't ever give us a countdown.
He doesn't. Are we live?
Oh, great.
Okay, I have a question for everyone. What does Haktua mean? I just heard it, so I was just wondering.
You did not just hear it.
All right. On that note, let's get. Well, so today we're going to get into. Well, one, we're back. Kenji was gone for a while, and he runs the whole live thing. We also had a bunch of clients to attend to, and so I could have just opened up the computer and done a kind of a ghetto live. We could have done that, but we chose not to. So we are back on our Tuesday lives, as we almost always will be. Mahe's back.
Hello. I don't even remember
Were you
where I
ever gone?
went. Oh, it's gone for something.
Have you not gone live since you went mainland and visited Cal?
I don't know, honestly.
Okay, maybe. And anyways, we're back. So we'll start with client testimonials. Let's go first. We're gonna get into agent questions. Sorry, let me plug that first. Aiden from our team had this idea. He said, Derek, I want you to make this video, selfie, tell everyone that we go live on Tuesdays, whether you're a future client or active client or even past client. Do you have questions that you want answered on Core Team's Tuesday lives? And we got some responses, so we're going to be answering those today. So people asking about life expectancy of single wall construction homes, which is actually a good question. Like,
Yeah.
if I buy this shack, how long is it going to last? Asking about affordability, like, could I really get a single family in this range? Asking about living in Diamond Head. I feel like there was one more that I'm not getting right now, but if you have specific questions, always comment. And throughout this live, if you're joining us, always comment. If you're watching this after the fact, even if it's 6 months later, throw comments in, and we'll try to take those questions and use them on next week's live. And if you're looking to buy, sell real estate, make sure you get plugged into our system, because you could receive one of these calls from Charlotte, and she can say, hey, I know you're 6 months out, but is there a question you want them to address on the live? So make sure to go to coreteamhawaii.com, register if you either have a real estate need or you're going to have a real estate need. Okay, now let's get to the client testimonial. First, we got Kenny this week. Kenny has been very helpful to me going through the decision process, and giving me his advice is very, very helpful. Kenny is really good. That's Corey. Corey was a referral from Scott. Shout outs to Scott if he ever watches this. Thank you, Scott, for referring Corey. And thank you to anyone and everyone. Occasionally we get someone who watches the channel or knows us in our personal lives, and they refer clients, and we love that. In fact, I'm going to be talking with a guy today, referred from Ryan. So good job, Kenny, who's right over there. Next one we have is from Mahe and Aiden. Mahe and Aiden, they've been super responsive. We were just texting back and forth just seconds ago. Ha Everyone is. How are you going to do that when you're reading it? Ha ha. Everyone is very responsive, on top of things that need to get done, and proactive. I like how straightforward they are and kind of understand what we want, and they don't feel they don't need to sugarcoat anything in a good way. My assistant writes this, so bear with me a little bit. They don't sugarcoat things in a good way. We ask them questions. They give us direct answers. It's really good communication. When something is good, they tell us it's good. When something is bad, they tell us it's bad. Makiko. I love that one.
Yeah, me too. Thanks,
Yeah,
Makiko.
I love that one.
I'm going to see them tomorrow again.
I'm going to... Want me to read into this live I'm going to do it anyway.
What?
So Charlotte's interpretation, she goes, I like how straightforward they are. They kind of understand what we want. So that could be they like partially understand, or that could be, like they kind of get it.
Yeah. Or that could
And
be
I
a
think
typo.
it's the latter. And it's a typo, yeah. It's the latter. But the reason why I emphasize that with them is they are probably the only client of hundreds of clients who seriously, down to the wire, might buy condo in town, might buy single family in town. Mm-hmm. Almost always, if you are there at the consult time, that's fine, because our education, our talking about finances, culture, lifestyle, commute, it's going to hone us in. also for most people, it's a matter of price. What they
Yeah.
want for what they can afford, it naturally brings us to an area and an asset type.
Yeah.
With them, though, their budget is high, and they're like, we're really unique. Like, we want to be this many minutes to this, this, and this, no more than this many. That could mean we go condo. That could mean we go single family.
Yeah.
They're the only one, right?
Yes.
They're the only
So
one.
far, yes.
Yeah.
Yeah.
Which is kind of cool.
Yeah.
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 So we definitely get what they want. Just throwing that out there. All right. Should we just jump into?
Might as well. I'm also looking at like the topics that Kenji put for what today's live is.
What are you whispering to me on the
I
side?
don't know. Well, because I'm like, oh, okay. Well, was I supposed to have watched that then, since we're supposedly talking about this on the live? Because I absolutely did not watch the
What is it?
presidential debate.
No, so I put presidential debate and interest rates because Jody Tonga from Pacifica Mortgage is going to come in and give us a rate update. I saw a headline that said like debates, you raise rates or something. So she can either confirm or dispel that. I don't know if that's true. But I put that because it seemed like a good thing to get you to click on our our thing.
Well, you got me.
I got
I was like, oh dang.
I watched a little bit
wait.
of it. I watched a little bit of it.
Okay. I couldn't stomach it.
I'm not sure it's America's finest hour, you know, but I watched a little bit of it. But what are the other non-presidential debate things?
Oh, that was it.
Well, one was
No, I thought it said climate change for a second. I was like, what?
no. Okay, let me pull it up.
Client questions,
So-
presidential debate, interest rates.
Well, Daniel says, you want to read that one?
Oh, I got to pull
You
it
have
up
it?
now.
Daniel, right there. Daniel says,
What is the life expectancy of a house with single wall construction and jealousy or louvered windows, such as those houses in Coconut Grove, in Kailua? Is this a wise purchase? Is double wall recommended and preferred? What are the pluses and minuses for both?
so how long is a single wall construction home going to last?
I mean, my family still lives in one.
So, if you see a house sagging, falling over in Hawaii, I think it is more often single family than not. Or sorry, single wall than not.
Yeah.
I don't think that it's the house's fault necessarily.
Yeah.
But let's unpack that.
Yeah.
Those homes being single wall construction, so it's not drywall, it's not green board, it's not these things. More prone to it's non-treated wood, especially the old ones.
Yeah.
They're more prone to termite damage. So
More prone to termite damage, less insulation, it's hotter, less effective for ACs if you put that in. Usually has older window systems, but not too hard
but
to.
that doesn't mean it's not going to last.
No.
Like just those things don't. It just
Yeah,
means
it's-
could be less comfortable in the wrong climate.
Yes, yeah, but they're like the single wall is not that hard to fix either. Like if say you have termite damage or something in one of the panels in the single wall, that's like a matter of replacing the panel. You know, it's
Well, point being, I think if you don't, they say you should tent your home every 5 years. You should get inspection every year. And so if you're not taking care of a home for a generation, you know, it's been 20 years since termite tenting, et cetera, the single wall is just going to end up having problems quicker
yeah.
than the drywall double construction vinyl window home.
If you defer maintenance on a home here, single wall is probably going to be the first to go, then your double wall, and then anything like CMU, which tend to last forever. You know, CMU, that type. Like you can leave that alone and not do anything within it. It can generally survive quite a bit of
Especially
deferred
CMU.
maintenance.
Well, another thing, speaking of concrete blocks, another part to this is typically single wall construction homes
Post and pier.
are on post and pier.
Yeah.
So you're on this, there's every, you know, maybe under the home, there's like 10 different of these posts coming down, sitting on a concrete block. And so that's another thing. Rain sweeps earth and gravel out, and now the home kind of does this.
So
and
like
buckles, and now
appropriate, depending on the
one more thing,
gradation.
add termite damage. So it
Yeah.
does this, and it was termite damage. Then, so how long are because I'm going to leave, how long is the single family home in Kailua going to last?
As long as you are maintaining it for.
As long as you maintain it for.
Yeah. Yeah.
But I can see why the question.
Yeah.
Yeah, sorry, you were going to say?
No, that's
You
pretty much
forget.
it.
Yeah. It's a good question. So if you're going to build new single wall today, could it last your whole life? Like 100%. They still will like move a home from Manoa to like the North Shore or something, like on a truck. Maybe they cut it in half. But these homes, these historic single family homes still exist from like the year 1900. So it depends on how it was maintained.
Yeah.
You don't have to avoid them, but you could if it's not for you.
Yeah. It's not for everyone. There's a little bit different maintenance that goes on with it. It's hotter. You know, if you want a more modern, you can add.
It's hotter. It could or could not be hotter because the double wall home.
I guess depending where you are.
Well, it has the jealousy windows. Usually they're built for breeze to flow through because they were built to not be air conditioned. So for no AC,
yeah, but there's like zero insulation. That's true. When it's hot outside, you're hot inside too.
I don't mess with them. So Mahe knows. All right, Jody is gonna come in and take this seat for me, and Mahe and Jody are gonna carry it the rest of the way.
Okay.
CoreTeamHawaii.com. Real estate needs. Hit us up.
Thank you. Bye.
I have to go pick up my kids.
Okay. Bye. Hi, Joni. Okay. Let's see. Okay, we have Miss Jody here, our mortgage mafiosa. So we're answering some questions that people have sent before. Here's one that I feel like you can also help with. Question: is a mortgage between $3,000 and $3,500 possible for a single family home, preferably standalone and detached? So there's a few things that affect whether or not that can be true. And since we have Miss Jody, we can have her help us answer that.
I would say, that would be tough. You'd need a down payment. I mean, if we're talking the lowest priced single family home on island could be around
maybe like 700 around there. And this is for something that you could live in, move into. And if we're using all of our liquidity for our down payment, you got to make sure that it's move-in ready, because if it's not something that you can live in, or if it's not in good enough condition for them to be able to give financing on it, that's one issue. And then if there needs to be a bunch of work done, if you are tapped out of your funds because you needed that to make the mortgage what it was needed to be comfortable for you, then you don't really have the room to repair this home now. So 700-ish. For the lowest.
Right. So if we're saying 700,000, then we're talking about, like, if we're doing zero down, we're talking about like 5K. Actually, with taxes and insurance, we're talking about like 5,500 a month, give or take. And then if we're talking about, with a down, then maybe you're financing 500,000, right? So then that's still going to be above 3,500. So
maybe we get a seller credit, and maybe we do a buy down on the rate to help a little bit.
Right.
Yeah.
So that would definitely work, and that would definitely get you in the range.
Yeah.
So as long as you could qualify. So the thing about the 2-1 buy down programs is that you have to be able to qualify for the interest rate that you're locking in at. So even, it's not like some people want to qualify for more. So they're like, well, what if I do a 2-1? Because then my rate will be 4% for the first 12 payments and then 5% for the second 12 payments. That doesn't work to increase your qualifications.
Okay.
But as long as you qualify for the 30-year fixed rate that you're being quoted, then you're going to save a ton of money by doing the 2-1 buy down.
Got it. So it works only if you qualify there and you're like, that's uncomfortable for me. But with the 2-1, we could do it. Okay, got it.
We've gotten a handful of those accepted recently. So
yeah,
they're still around.
They're still out there. The opportunity is still out there. It needs to be the right house though.
Yeah.
So it's not everything we go in we're able to get a credit for. So if it's a competitive property, if it's in an area that, or if they're priced to sell and we know we're in competition with other offers, we may not necessarily be able to get that. The sellers may not be agreeable. It may weaken our offer. But if it's something that's been sitting on the market for a while, let's discuss it.
Right.
Yeah. Okay. And to kind of just elaborate on why that question came in. So one, not really like short answer, not really accomplishable if we're just like 0 down or very, very low down and we're not doing anything fancy to bring that rate down and make the payments lower for us. A single family detached home is not super accomplishable unless you have money to put down at $3,000 to $3,500.
Right.
Even on the west side, because I see that you're also asking Houston, what about, on the west side? So that may not be accomplishable there either, unless we have some kind of a down payment. So yeah. Dr. Darrell. Okay. So his question is, how high is too high to pay high HOA dues? And we'll kind of like segue into his other questions. Like what are some HOA red flags? So Jody is a great person to have next to me while we kind of like answer this question, because we are continuously collaborating on HOA issues and, HOA red flags and things that, we either are researching and doing due diligence before we're submitting an offer. Like, looks like we're going to lock one in today.
Yeah.
That has taken a lot of work.
Yes.
And it's been a lot of like HOA red flag stuff.
Yep.
So how high is too high for your HOA? That depends on you.
Right.
That depends on what your budget is. That depends what neighborhood you're looking in. What, a HOA can be a townhouse as low as like 300, or
Right.
it can be a condo in, downtown Honolulu as high as 2,000.
Right.
It can be totally different wherever you are. And the answer to how high is too high is entirely dependent upon you, your comfort level, your threshold for that higher payment. What is your budget? What can you afford to pay monthly, whether you're financed or not? What's
Right.
a comfortable payment for you? Does it make sense for you? Are you an investor? Are you owner occupant? Are you an investor and you need to rent that out? And the HOA makes it such that you are never going to even come close to breaking even on it.
Right.
There's a lot of different questions to ask when we're asking how high is too high. A couple built-in things are there assessments attached to it? Is it an old building? Do they have an assessment for spalling? Do they have an assessment for elevator? Do they have an assessment for fire sprinklers? And if they don't currently, are they expecting one? Is it a building that we know they're going to need to do the fire sprinklers? Therefore, we can imagine that there's either going to be an increase in HOA or an assessment attached to it later.
Right. And I think also it just has to do with like, what amenities do you want?
Yeah.
And what is it that you're actually paying for? Because if you're paying a huge special assessment for some foundational issues in the parking structure, that's one thing. But if you're paying for a spa, a movie theater,
That you never use.
a golf putting green,
Yeah.
and all that stuff, that's another thing. Like, so we're working with people now that they were like, well, as long as it's under like, $1,500 a month HOA, like, and I'm like, and he's like, is that reasonable? And I was like, that's real high.
Yeah,
Like, that's really high.
Yeah.
But, and he's like, then I started to see the properties he wants. Like, he wants like a gym with a sauna, with the pool, with the rec room, with the, like, I'm like,
Yeah.
okay, yeah, sure. 1,500 makes sense for what you're looking for. So
Right.
it's like, what is the HOA paying for? If you have an understanding of that, that's how you're going to know like how high is too high.
Yeah, 100%. And then when we are talking about HOA red flags from a lending standpoint, what are like the top things that you would say are like, that's causing me pause for underwriting. I don't have a good feeling about it.
So for sure, like some of the good old red flags, litigation.
Yeah, litigation.
That's like been around for all the times, all the days. And it's like, what is this litigation about? And who is suing who? So is it the HOA suing someone? Or is it a homeowner suing the HOA? Or is it a bunch of homeowners suing the HOA? Or is it the homeowner suing a previous contractor? Like, what are we talking about?
Yeah.
What's the reason? And so usually we get a summary of the complaint.
Okay.
And litigation is not something that, I mean, I guess it depends, but it's not something that gets resolved quickly. So it's not like, oh, I called the HOA and it sounds like they're like about to button it up. Like I've had associations that have been buttoning something up for, 10 years.
Yeah.
So
Would you say that it's like, which way is better? Is it like better and better chance for being able to lend on it if it's the HOA suing somebody, or does it matter if there's any kind of litigation at all?
Usually we don't like it if the HOA is suing somebody, because that means that there's mostly grounds, more likely than not, for faulty work. Usually, typically.
Okay. Yeah.
Like,
okay.
they have evidence, like they have
Yeah.
proof. They've actually hired a lawyer and they've taken it that far because they have some sort of proof that, like, well, we paid you to come in and do this
Yeah.
service and, like, you did a crappy job, right?
Yeah.
And so then it's like, well, what did they do a crappy job on?
Yeah.
Like,
Yeah.
is now, are we talking about foundational issues? Are we talking about structural issues?
Yeah.
Yeah.
Okay. That makes sense.
So litigation for sure. Special assessments.
Yeah.
We need to understand what the special assessment's paying for. What's the project? What's the duration? How much did you budget? Is it a realistic budget? So if you've budgeted to add sprinklers into the condo and you've budgeted like $1 million and it's going to cost like $5 million, then it's like, well, where's the rest of the money coming from? So it's like understanding the budget.
For special assessments. So say there's a special assessment that we know of, it's X amount of dollars, but the seller has, per the contract, agreed to pay off the remainder of the assessment. Does that affect how the likelihood of getting lending on it for our buyer?
I mean, that's helpful, but we're still going to have to look at the reserve study.
Okay.
So the reserve study is going to just tell us if there's a balanced budget.
Okay.
So like based on what all the homeowners are paying every single month, does it balance to the expenses that are going out for the foreseeable future? So not just to say it's balanced for 2024 and
Yeah.
2025,
Right.
because if we know in 2026 they're adding $1 million PV system, then is there already $1 million in reserves,
Yeah.
or how are we funding that $1 million?
Got it. So just because the special assessment is promised to be paid for by the seller, it does not guarantee that financing is accomplishable.
Right. It doesn't guarantee it, but
Yeah.
it definitely helps.
It helps.
Because
but
then we don't have to
keep that
hit
in
them
mind.
from
Yeah.
a debt to income ratio perspective. So it removes one layer of
Yeah.
concern.
Okay, got it. And then let's see. In your experience, this is not a question from somebody, but just because everybody was always asking about this. What are the things that you're seeing right now that are I know there's an increased level of scrutiny when it comes to all home purchases and not just condos.
Correct.
In practice, what are the things right now that you feel are like the most scrutinized?
So in terms of something new, is being able to get insurance, to source insurance for the property,
Yeah.
homeowners insurance. That has never really been on our radar. Like, sure, it might take a little bit longer, but it's not a matter of like, are we going to be able to find a company to insure this property? That's never really been a concern. It's okay, we might have to broker it out and they might have to pay a little bit more for the insurance.
Yeah.
Now we're finding out where age of the roof
Yes.
with pictures.
Yes.
We're finding out like matching square footage to what is publicly recorded.
Yeah.
So you're marketing it as 1,500,
Right.
but public record has 1,200.
Yeah.
So where's this 300 coming from?
Yeah.
And is
An
it
insurance
insurable?
company is not wanting to
Right.
cover that.
Right.
Because it's not permitted.
Right.
Which is super common in Hawaii
Super common.
to have parts of your home be unpermitted. So that's kind of a biggie.
Big.
What else? So what did you say before that? I wanted to like kiki off of that.
Insurance.
Property.
Roof.
The roof, yeah. So that's becoming a lot. I mean, that always was something that they looked at, but now it's just like so much more specific.
Right.
And, like,
now it's like, we'll give you a quote and we need to see a copy of the appraisal. So like we just did a 20-day close, which was crazy. But part of that timing that we had to like count into our reverse engineering of the timeline was sourcing the insurance, finding it,
Yeah.
because this was a very unique property,
Okay.
and then getting them the appraisal report in time so that they could not just give us a quote, but see the report, send it through their underwriting,
Yeah.
which is like,
Yeah.
when was an insurance underwriter ever important?
Yeah.
Like, you're not important, but they are.
Now they are, for sure.
Right now, it's like, who's the underwriter? Like,
Yeah.
when are they going to be able
Yeah.
to look at the appraisal report? What's the turn time on that? Right now, we're having to add in days of turn time to make sure that the insurance underwriter has time to audit the appraisal report. And they might come back with questions. So not only is our underwriter going to come back with questions like, okay, well, I was looking through the report and I noticed this. I need the appraiser to go back and comment on marketability of the property, being that it has XYZ, right? So they're coming back asking us for revisions to the report. And then now we have the insurance underwriters coming back asking for clarifications and revisions.
Yeah.
And all that coupled with like still clearing deed and title and income qualifications and asset qualifications and all the rest of the stuff. So it's definitely something that is on our radar.
Yeah.
Where we're like on day one.
Yeah.
Day one, the day the offer gets accepted, we're sourcing the insurance,
Okay.
which is new.
Yeah. And I'm sure that we'll get more insurance questions at some point, I'm sure, but we don't need to make this all about that right now.
Yeah.
Kenji, did you see anything on the comments that? Okay. So DL Mosa already handled Hunter's question. Thank you, because I don't really know about firearm issues here. Larry Tran, aloha mahe Derek core team. How's it? Good clickbait title. Got my attention now. Okay. Do you have any info background on the future new construction in Manoa? Future new construction in Manoa.
Yeah.
We'll have to do a whole thing about that because I'm not familiar, and that is interesting to me. Like where?
I think it's like that one in downtown where it's an existing building that they're
Revitalizing or whatever, like a refurbished iPhone.
Yeah, and I feel like there's a lot of protests associated with it.
Okay, well, we'll get more info on it, and then we'll address that on another live. But interesting. Michael, hey Mahe, what's the process for a cash buyer? What would I need to know or be prepared for? Oh, well, you need to have it depends. Well, call me first. Let's get on a consult so that we can determine what exactly you're looking for. But if you're cash, it's pretty, you don't need to be pre-approved if you plan to pay all cash. So that process is already done. We'll just need verification of funds. Sometimes we need that in order to show properties. If you don't have a pre-approval, they may want to see a verification of funds to make sure that you are a qualified buyer. And then really it's about, finding a property and writing offers on it. The property or the process can be shorter for a cash buyer because there are less things that are required. Like we don't need an appraisal for a cash buyer. Termite is not required per lending, but still advised and still something you can ask for. It's pretty straightforward, a process when you're cash. So if that's something you're like pulling the trigger on soon, or if you're just wanting to get more I already have your information. I'll touch base with you on the side as well. But not a lot of preparation needed on your end. It's really about just like pulling the trigger and finding something that you're ready for.
And then the due diligence for when you find something.
Yeah.
In terms of title work, in terms of understanding what liens are associated with the property. These are things that are not going to be underwritten because you're not borrowing.
Yeah.
So definitely, fine tooth comb associated with title work, survey, home inspection.
Also condo docs. If you're
Definitely.
buying in a
Definitely.
association that has association docs, usually our lender partner, they're another set of eyes that is like peeling through those documents to ensure that it's like a good sound investment for them and you. You don't have that extra set of eyes as a cash buyer, but there are third-party companies because I'm not an attorney. I can't advise you on those things, but we can refer you to a third-party company, and that's kind of like their whole job. They just read condo docs for you, and they prompt things that would be called probably to attention by a lender. So as a cash buyer, Obviously, it's up to you. It's totally up to what you want to do, but we always do kind of recommend that you get that assistance and that extra set to kind of help you read through the condo docs and look at it, because I feel like the average human cannot read that in the way that it needs to be read
Right.
to determine what they're actually walking into. So getting the help and paying the extra for that, I think it's like $350 or something like very worth the investment to
Right.
do that. So
Right.
yeah. Michael. BD. Currently, housing market is cooling quite a bit in the Midwest. Curious what the trend looks like in Hawaii right now. Do you think trend is following seasonal cycles or something else? Okay. So we just came, I feel like we're settling into a groove right now. I wouldn't say that it's necessarily like super cooled off. There are different little microclimates and markets here in Hawaii, on Oahu, where we primarily do work. We do outer islands too, but primarily we're servicing our Oahu clients in a direct way. But we have such like niche little microclimates and micro markets on the island that one area can be hot and have like a ton of buyers offering on it consistently because that area is, you know, like a Kailua house at 1.2 or 1.3 or anything 1.5 and under, always going to be in competition. And then there can be, you know, someplace like Eva Beach or something where it's more tract home style, where maybe we have 10 other, you know, similar products out at the same time, where it will take longer to maybe move that property. So I would say just in general, we are not as massively competitive as we were in 2021. No. But even from this past few months, so the spring, summer season is just like a natural PCS season. It's a season when people are wanting to move. People are wanting to close on their homes and get into things before the school year, before their kids started a new school district. There's just a lot of reasons where, you know, nationally people move during the spring and summer. And we definitely experienced that. We had a lot of competition for our buyers. Jody knows we've missed out on a bunch of offers now, which is like, you know, for a couple of years, it wasn't as difficult to get our buyers accepted. Maybe we had a couple others competing with us, but we've had some pretty tough, like competitive offer situations over this past like spring, summer season. So I in practice would not say that it's cooling, but it's cooler.
Yeah.
It's cooler. Yeah. I mean, I know you do business with other realtors besides just us, but on a lot of stuff we have going on together, that's what I've observed. What about with your like other agents that you're working with? Are you seeing more competition for the buyers that you're representing, or?
Yeah, I mean, it depends on the location.
Yeah.
Because like we have one that, you know, it was Nu'uanu, listed at 1395. Our buyer went in at 1505. He was competing with like 5 other offers. So we'll hear back today on that one.
Okay.
But like, that's an example
of
like, no one was ever going to be offering 1395, which was list price. So, and then on the flip side, I have a whole bunch of buyers that are, I don't want to say they're house hacking, but they are looking for a deal.
Yeah.
So they, you know, they submitted he submitted 3 offers and all 3 got countered with credit. So like he went in asking for a bambucha credit.
Yeah.
But all 3 got countered with not a bambucha credit, but with still a credit enough to do 2-1.
Okay.
So all of those, you know, are west side. And all of those are in like the 700 to mid 800,000 range.
Okay.
So I think there is going to be your deals. But yeah, Kailua's Nu'uanu town.
Anything like close to town, anything on the windward side?
Yeah, windward side, Hawaii Kai. I mean,
Yeah.
we're still seeing a lot of competition in those markets.
Yeah.
Yeah.
Yeah. So long story short, it depends on the neighborhood. It depends on where you're offering. It depends on what the product is. If it's, you know, a condo in an area where there's a ton of condos and they're consistently coming to market, then maybe we got some deals there. If it's, you know, a Mililani Malka, $1 million single family house that rarely comes up, then you're going to be competing.
Right.
Yeah. Okay.
And some of the condos are definitely sitting
Yeah.
more than 60 days.
Yeah. And it, you know, there's a couple of reasons. One, we have this like insurance thing that's like kind of looming over people. And And even if we do all the due diligence and we realize that that building is fine for now, there's still like a level of apprehension that a lot of buyers, I feel like, are just having when it comes to purchasing a condo. So we have a lot of clients. I wouldn't say a lot. We have a few clients right now who are actively buying or actively looking who, even if, sometimes the determining factor is your budget. If you want to break into the housing market, if you want to have a foothold in the real estate market and have your investment start working for you, condo is the option. And sometimes that's where you're at. That's where your starter home needs to be at. And that definitely still makes sense. So please don't, be hesitant to reach out to us and ask us and to help you and have Jody help you, like reverse engineer and do the math with that, because a lot of times it still makes sense to buy, even if there's a level of apprehension for condo stuff and HOA stuff and insurance stuff. Let us help you work through those things so that you can make the best decision. Yeah. It's not always like a no.
Right.
Yeah. What types of buildings are having more difficulty when getting association insurance policies? Old versus new, condo high rises, building material types, or townhome communities having difficulty as well? So it's the, concrete supposedly does better.
Right.
Or the amount needed to get them to full coverage is not as much as steel frame.
Right. High rises more so than townhouse. Harder.
Yeah. High rises are having more difficulty, but townhouses are not out of trouble.
Right.
We did see like the Mauka townhouse that we bought together and then I helped sell. That their association went up like $500 like the month after they sold. So at the time when that house was being sold, the questions that the lenders were asking was, does it have full coverage? Master insurance policy, Sue Savio, said, yes, it did. But I don't know that they were looking at sublimits at that time, like specifically. See, so even just like certain things were not looked at just a few months ago.
Just a few weeks ago.
Just even a few weeks ago.
Like you can even say a few weeks ago, because different lenders have different policies where it's like if they've recently closed one, it might fall under like this umbrella where it's like, okay, since we recently closed it, like we don't really have to look at ABC.
Yeah.
Like they're not looking at certain items because we just closed it.
Yeah.
Right. But and so some of them are definitely flying under the radar, which would not be okay if these lenders didn't have these particular rules. Like if we've closed within the last 90 days, then we don't have to look at the insurance.
Right.
Stuff like that.
Yeah.
Right.
Yeah.
So whichever lenders are not making changes immediately, and it's not easy to make changes. Yeah. Like as a corporation. Yeah. Those are the ones that are potentially misdiagnosing a project.
Yes. And this is why it's very important to have somebody like Jody and Pacific Rim Mortgage who are consistently being up to date. She's on meetings, she's on phone calls, she's learning and getting as much data as she possibly can. Because, for instance, escrow that we had together that we canceled on because of something that was a problem at that point, but not a few weeks prior. Now, they were able to close the previous lender because they maybe missed something, right? Like something went under the radar. Right. However, that project for that buyer, that new owner, now becomes something that they better hope to be in it for a long time. Yeah. Or they better plan to be in it for a long time, because now there will be issues. Now it's like not lendable. Right. So.
And it's like they just closed.
So
for them, it's, for any buyer, I mean, we really need to make sure that there is this time given for understanding, because it's not easy. It's not like really easy stuff that we're explaining. Yeah. There's like multiple categories and reasons that could disqualify a property from being lendable. Yeah. And that really impacts a buyer's exit strategy. And we care a lot about your exit strategy because we care about your investment, and we want to make sure that what you're doing makes sense.
Yes. If you have a lender, if you are talking to a lender and you're buying a condo and they are not asking you about your exit strategy, then talk to another lender. Yeah. Like get a second opinion. Yeah. Because that's very important right now.
It's so important.
Yeah. Okay, not sure. I've seen the videos. How do housing reassessments work in Oahu? Here in Chicago, it's every 3 years, but I know there are multiple ways it can be done. Housing reassessments, like tax assess? Like, what do you mean by that? Like tax assess value? That's a yearly thing for us here.
Once a year.
Yeah, once a year. And interestingly, I was like doing some comps and stuff last night, and I was noticing that a bunch of the properties that I was looking at, like single family homes in Kailua, they went down a little bit. Like
Mine
quite
did.
a few. Oh, did it?
I looked at it and I was like, oh,
Hawaii homeowners, right now is the time where you can look, and it should have re-upped for 2024 by now. Curious, let us know what is the tax value of your house doing lately? Not that okay, that's another thing we want to get out there for people potentially buying. Your tax assessed value does not necessarily equate what your house is worth, and it is not the same as market value. So even when we're looking at things and we're looking at tax assessed value is like 1.5 or whatever, okay, that property could go for 2 million because it depends what's the community, how hot is that property, how much do people want it. There are some homes that will go way over assessed value, some that will go at, some that will go under. So that's not a good indication. It's not the only indicator for house value. And I would not count that as something that we can rely on to be like, oh, I'm going to offer this much because the tax assessed value is X. So keep that in mind.
so like, whereas in California, the moment that there's a sale, that's the tax assessed. So it's like it's tied to that.
Interesting.
Yeah. And so that's why I think a lot of people come from the mainland and they're like, why would I pay $800,000? Why is it listed at $800,000 when it's tax assessed for $701?
Yeah.
Like I want to offer $701. And then we're like, oh, well,
Okay.
that's not.
Yeah, that's not our market value here.
Yeah.
So, okay. Oh, interesting. Yes, tax assessed, he said. So yeah, that's it comes out once a year. Not always the sale price, obviously. And it really depends. And also another thing people don't always understand is like some states, the land is like worth nothing, and it's all about the improvements or the structure, the dwelling. Hawaii is all about the land.
The land.
Is all about the land. Like I ran something last night that it was like, the land was assessed at 1.5, it'll probably go for 1.7 or something. And the house itself is only worth like $80,000 of that. So land is worth a lot here. So that's also something to keep in mind when we're like, oh, we don't have the budget to do a house. Maybe we'll just buy land and build on.
Right.
You need a bigger budget to buy land and build on because now the land is what's expensive. And then the construction process, the permitting process, the time to be able to sit without having a structure there. The pocket depth needs to be quite deep for that.
Very, very deep.
Yeah,
because in order to even qualify for land purchase, you need to prove how you're going to be able to construct. And you need to prove your exit strategy. So a land loan is only 36 months. So you need to prove how you're going to be able to get the construction loan to pay it off. So we're effectively underwriting you for a construction loan.
Down payment's higher too, right?
Yeah.
Yeah.
And even though we're going off future value, one of the cool things about construction loans is that you go off of future value of what you're going to construct. So if you're going to build a 4-bed, 3-bath that is going to be worth $1.5 million, then you get to finance like 65% of that, right? But with that 65%, you need to pay for your construction and you need to pay off your land loan. So reverse engineer to when you're trying to buy land, I need to prove that you're going to be able to finance what you're trying to build.
Yeah.
It's really, really hard. Really, 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 really hard.
Yes. And I feel like not a lot of people realize how difficult that is.
Right. Like I really hate, it's a tough conversation. Like I feel like I'm just kind of like killing someone's dream.
I do too. I always feel so bad because I'm like, I get it. I see the vision, but it's just a different beast out here. And it's not easy.
Yeah, I mean, maybe on the Big Island.
Yeah, maybe on the Big Island. Yeah,
you can.
But I think people have like this this homestead dream, of like living small and modestly. And
right.
That's just those two things, living small and modestly, just don't go hand in hand with like building new on vacant land.
Well, and that's the thing too. Is like I have buyers that are saying, well, we literally can live off grid in a yurt for 10 years. And I'm like, well, then you need to prove to me how you're going to be able to pay off the land loan in 36 months.
Yeah.
That's what the bank needs to know. If you're not going to construct and you're just going to live in a yurt or some sort of manufactured something that you can buy for like $35,000, then you need to prove how you're going to pay off the land.
Yeah.
Yeah. It's tough. But I did see, on the Big Island, you can still get like an acre for like a couple $100,000.
Me and Aiden are always talking about this. Like, oh, maybe we just like buy a couple pieces property next to each other, and then you go, and then I'll go, and then we take care of each other's. I'm like,
Yeah, of course.
no, we're not gonna do that. I'm gonna go live with Casey.
I want to go. Me and my good friend Katie, there's this like 10-acre lot on the Big Island, and it's $500,000. And we're like, we got to do it. Like, we got to do it
And
so
just
that we can
build a
build our
compound.
little compound in
yeah.
the future, right?
Yeah.
But
Yeah.
Big
But yeah.
Island is not in our future for
A while.
until Dash graduates.
Yeah, I know. That's kind of where I'm at too.
Yeah.
Like, maybe we could do Big Island or even like Molokai for me, go back to Molokai. But I'm like, ugh. My kids are still young. We still like, I'm not putting them in, I don't want them to board. Like, can you board at Punahou at Iolani?
Yeah, Iolani, you can.
You can?
It's really expensive.
I would never though. I could never. Like, even if the option's there, but I would never.
I wouldn't
For
wanna.
me, I'm like, bro, you're gonna be gone in a couple years. Like,
Yeah.
I want to spend time with you.
Yeah.
No.
Yeah.
But anyway, I digress. Okay. Let's see. Are you getting more buyers trying to get mortgage assumptions when getting a property? Do you think it's better to do mortgage assumption versus getting a new mortgage?
It's a great question.
Yes, we definitely are seeing more people who are looking out for assumptions.
They're
who
trying.
are trying to find assumptions.
They're looking for the needle in a haystack.
Yes, but and just beware the situation. Sometimes like marketing a VA assumption is just that, marketing.
It's marketing.
It's marketing. It may not, timeline wise, it may not work for you. The big hurdle that most people are like, oh, okay, is that whatever the difference is between what the price is that you're going to pay for the home and what's actually left on the VA mortgage that you're assuming, you need to come up with that money.
Right. So if they owe $800,000 at 3%, which sounds amazingly fabulous, and they're selling for $1 million, you need to come up with the $200,000 plus closing costs.
Plus closing costs.
So let's just say 210.
Yeah. Plus maybe even 220, because depending on how long the actual process takes, each month that the assumption goes on, they are paying down the mortgage.
Right.
So timeline wise, although I have an assumption right now that seems like it's going to be fast. It's maybe like 60 days right now. But we also had one that took almost 10 months.
Right.
So
And I've had one that's taken 14 months.
oh my God.
And I've had one that's taken 30 days.
So it's like all up in the air. I will say that I feel like more of these like mortgage servicers are having like departments dedicated to the assumptions now, that it's become more prominent and more people are asking for it. But whether or not there's a dedicated department for VA assumptions at whatever, say it's a Penny Mac or, Mr. Cooper, whatever, whoever holds that, there's still the hurdles you need to cross. And it's namely, do you have $200,000 laying around? Sometimes people are like, okay, I can pull a HELOC on this property and
Right.
use that cash to, cover the gap in the assumption. Okay, make sure that your qualifications still work. How much HELOC can you actually pull out? Because if that's not your primary residence, there's a cap on how much you're even able to pull out on that HELOC. It may not be enough for the gap that you need to cover. There are people who assume that, I'll just borrow the rest of that. I'll assume whatever the mortgage is over here at Mr. Cooper, and I'm going to go to Jody and I'm going to have her loan me out $300,000 or whatever. No.
That's not allowed right now.
Yeah. Right now you can't really do it. I heard somebody say that there was one company that was like doing it, but it's not really. It's more like they're saying, she was kind of going into, I want to talk to you about that later. But it was like a simultaneous HELOC type of thing, but there were a whole bunch of like things attached to it, and I'm like, okay. So as of right now, if you want to assume a loan, be prepared to come up with the extra money. And if it's, something that has been owned for a couple of years, then odds are, if they bought it at a low rate and house is extremely appreciated or inflated over that COVID bubble, then there is probably a pretty substantial gap between what's left and the sale price now.
Right.
So just keep that in mind.
So what happens a lot when just to talk about like how we call it marketing, is because they'll market it, they'll bring you in, you'll submit your assumption offer, And then they'll say, well, hey, we really like you and your offer, but we did get a conventional offer. That's a 40-day close. So, you know, if you want to flip to a regular VA, we want to give you that option.
Yeah.
So we've done that numerous times. And it truly is marketing because they're not looking for the assumption.
Yeah. It's not a seller's best option
It's not.
to go via assumption.
It's not. So
It's,
when
you know.
I say needle in the haystack, I say like you personally have time, meaning you're in a cush current living situation where it's not like I'm on 90 days of TLA and then I need a house.
Yeah.
And you have the money and you find that seller that maybe is even looking for more time.
Right.
Right? Like that seller that's like, well, we listed early, but actually we're not leaving for another 3 to 4 months. So even if we were going to get into escrow, we were going to ask for a rent back.
Yeah.
So now it actually does benefit the seller to have a longer close. So that's the needle in the haystack. That's the trifecta that we're looking for. And that does exist. It's just, you got to be prepared for flipping to a regular VA and doing your regular VA loan.
Yeah. Yeah. And because a normal new mortgage and a normal closing timeline with, and when I say normal, I mean like predictable. Like we know the general time that this is going to happen. We are not beholden to, you know, somebody who has no incentive because it's not a new loan origination to really
Right.
do anything with any kind of urgency.
Right.
There's a lot less of like, oh, what's happening now? What's happening now?
Right.
Or where are we? Are we up to date? Like what's going on? So there's just a normal timeline. Like that is usually preferred. And so if we
Right.
have two offers, all things equal, except one is an assumption and one is a new loan origination
Right.
or cash or whatever, as a seller, I'm going the other way.
Right.
So, you know,
Even if it's a little lower.
yeah, even if it's a little lower. And that's the other thing. Sometimes on an assumption, if we're in competition, especially, there is kind of a premium. Like you may have to offer more. You may be overpaying for that product in order to be considered because your timeline and an assumption process and assumption escrow is not preferred. So
And you're getting the 3%.
and that's right. You're paying the premium to be chosen, to be selected above other offers and to get that rate.
Right.
It's extra work for everyone involved, the sellers included. There's like a ton of extra work that they need to do too.
Ton.
Paperwork, stuff that they need to be on all the time. A lot of collaboration needs to happen. Everybody needs to be like working together to
And
make sure it goes.
a huge majority of the time, the seller has to be leading the way
Yeah.
with communication with the servicer.
Yeah.
So like just in case you don't know, let's say I pre-approve you, but then you find a property that you're going to do an assumption on. I'm out of the equation,
Right.
which is totally fine. It just, but to some people don't realize that.
Yeah.
They're like, well, I want you to do the assumption.
Yeah,
And I'm
right.
like, well, I want to do the assumption too.
Yeah.
I can't. You need to communicate directly in conjunction with the seller directly to whoever the seller is paying their mortgage to.
Right.
That is the company
Yeah.
that's going to approve you
Yeah.
or deny you.
Right. Yeah.
And that's the other thing is you don't know what type of underwriting. So I've had someone get denied, which to me, I'm like, go back and ask them this, go back and ask them that. Because when I ran their numbers,
Yeah.
they should not have been getting denied for the assumption.
Yeah.
But they came back and said, you know, like, well, you're over 47% debt to income ratio, which for VA, you can go over 47% debt to income ratio. So I said, well, go back to them and say, I know that for VA loans, you can go,
Yeah.
I can go over 47, you
Yeah.
know, and my credit's excellent. And my residual income is over 200%. So that's just like a requirement. But, you know, and he went back and he said all the things and they still denied him.
Yeah.
So to me, I'm like, and he's coming back to me saying like, what gives? And I'm like, well, I mean, I'm not the servicer.
Yeah.
I'm just trying to help you, but
Yeah.
the servicer has the final say.
Yeah. And then what they're going to do? Like they already hold the mortgage,
Yeah.
you know, like, oh, well, it's not you. We still have it, you know?
Right.
So there's no incentive
Yeah.
there to like,
And it's hard to like, you know, he like called the VA and filed a complaint and did all the things. And I'm glad he did, right? But ultimately the VA is like, well, we're not the lender.
yeah, right.
There's nothing the VA can do about it.
Yeah. Yeah. What are the elements of association insurance? And we're just going to hit a couple more because I got to get out of here pretty soon. Okay. What are the elements of association insurance policies that lenders are looking for now that they didn't care about previously, which then result in a buyer being unable to get a mortgage loan? Insurance, different elements of insurance, not just full coverage, but deductible. What is it, a per occurrence? Is it a per unit? Ordinances A, B, and C. And that's just like last week. Like, who knows what it'll be next week? You know, it could be different. But those are the big ones right now.
Those are the biggest ones. So it's like, if there was a full loss to be suffered, how much is each homeowner going to have to pay out of pocket to have the coverage to then rebuild? Like, that's what the question is. It's like, how much insurance does each homeowner actually have if the building was to suffer a loss?
Yeah.
And who's responsible? What if it's not a full loss? What if only 5 units are impacted? Then what, right? Then what are the deductibles that have to be paid out of pocket? Since only 5 units were impacted, then now all of a sudden, does each homeowner have to pay $100,000 each before insurance kicks in? Those are the type of nuances that now are getting underwritten to where the lender is paying attention to, where historically it's, if the answer was that there's 100% replacement cost coverage, we're going. They said the proper verbiage, which is the question, is there 100% replacement cost coverage? The answer is yes. Boom, we're going. Right? Now it's like, the answer to that question, yes, doesn't actually mean that there's 100% replacement cost coverage. So now that we've learned that, you might not actually be fully covered. Now we're asking questions 2, 3, 4, 5, and 6. And that all has to do with deductibles, and that all has to do with not just dwelling coverage, which just means if there is a damage such as a fire or anything like that, but also hurricane coverage. So now we're talking hurricane, right? And then when Mahe is referring to ordinances A, B, and C, what they're saying is, like, if there is damage to the building, then what is going to be covered? So is it just the damage itself going to be covered? Or what if something is impeding you fixing the damage? If something is impeding you fixing the damage, are you going to pay for the cost of the impediment? So, like, will you pay if this wall, literally the machine can't get in to fix the damage, then will you pay to break down the wall so the machine can get in and fix the damage? And or if the damage occurs in 2024 and it's only going to, it literally logistically can't get fixed till 2025, but the cost to fix in 2024 was $400,000, but now the cost to fix in 2025 is $420,000. Are you covering $400,000 or are you covering $420,000? So, like, these are the types of questions that are now everyday questions that every single lender needs to know the answer to in order to deem a condo what we call warrantable, which just means that it is conventionally Fannie Mae, Freddie Mac, vanilla, able to be financed.
So I know that's a lot of information.
That was a lot.
But it's, and you guys are going to keep asking us, and it's going to continue to be a lot of information probably for the foreseeable future. So if you guys want or would be interested in, and we'll talk to Derek about this too, because we've been talking about maybe doing something like this. If you guys would like a sort of like, can't be evergreen because this is constantly changing. But like as of this date and as of what we're seeing right now, like a sort of a masterclass situation on like how it needs to happen, let us know. And that may be something that we will collaborate with our lending partners with to try and get that for you. And maybe an update later as well. We have one last question that we can hit. Continue to load us up in questions afterwards, and we'll get them on the next one. But for today, we're going to end with this one last question from Missy. And this is a good one for Miss Jody before we sign off here. For a conventional loan, what do you need to qualify with excellent credit? Just wondering if qualifications are different in Hawaii than on the mainland due to the higher home prices.
Great question. Generally, the guidelines are going to be the guidelines across the board. So guidelines in California are going to be the same as guidelines in Hawaii. However, there are different county like loan limit allowables. So you're allowed to borrow way, way more before entering into jumbo territory in Hawaii than any other state, really, which is great. However, like when it comes down to typical guidelines like debt to income ratio, we're still talking about 50%. So 50% of your gross income, we have to stay under that when we factor in all of your debts plus the proposed mortgage. And then as far as excellent credit goes, that's great because that's going to do things like lower your private mortgage insurance if you're putting less than 20% down. And that's going to get you the optimal interest rate. But you still have to meet under that 50% debt to income ratio qualification. So like I've had conversations with people that are like, I have an 800 credit score. Like I don't understand why I only qualify for 500,000, you know? And I literally walk them through the math. I'm like, well, this is your gross income. These are the debts you have. So you have a 500 car, you have 200 in credit card minimum payments, and then you have 100 in student loans. And you want to qualify for this much. If I add all that together, your debt to income ratio is like 79%. Right? So it's literally math. So we have to take your gross income and then cap you at a 50% debt to income ratio.
And then like, where does your income come from? How long have you been with your company? Like,
right. And then there's like, if you're not salaried, then there's going to be questions like, if you work overtime, have you been with your company for more than 2 years so that I can do a 2-year look back on your overtime? There's similarly to night differential. Similarly to like if you get paid, some construction workers, they get based on the job they're on, like they'll get paid $40 an hour, but then when they work this specific job, they'll get paid like $70 an hour, right? Stuff like that. And then the other big one, of course, is going to be bonus and commission. So if you're on $25,000 base salary, but you make a ton in bonuses and commissions, then that similarly to the overtime, we need to do a 2-year look back. So if you started in 2023 and you were just ramping up and figuring out your job, so you only made like maybe $30K in commissions, but now 2024 you're rocking and you've already made like $90K in commissions. Those are things that I'm going to say, let's wait until the end of 2024 so that we can do this better average for you. But those are all things that, you know, we would go over in our consult anyways.
Yeah. All right. Well, thank you. Thanks, Missy, for the good question. Thanks, everybody, for your questions. And as always, coreteamhawaii.com. Fill out the contact form if you want to have conversations about the market, about buying, about selling, or if you want to be connected to Miss Jody Tonga and the team at Pacific Rim Mortgage to talk about financing. Maybe we're reverse engineering some current numbers. Maybe we have aspirations to buy in a year or two. Whatever it is, let us know. Give us kind of a breakdown of what you're looking for, and we would love to be the ones to help you.
Yeah.
Okay. Thanks.